There's a lot of talk going on about the direction of our economy. I'm sure you've read the ominous headlines. Inflation spiked the highest in 40 years. Fears of a looming recession in the US, or even supply chain crisis taking a toll on American families. Not only that, but all around the news, you hear politicians campaigning. Something must be done to stop inflation, or the Federal Reserve must take action now. But what they're not telling you is that historically speaking, anytime the Federal Reserve looks to take action to combat inflation, the housing market is the first to take a hit. I know what you might be thinking, but hey, I'm not looking to buy or sell a home. What does potential housing market crash have to do with me? The truth is, it has everything to do with you. Welcome to Complex Economic Systems. It's essential to understand how a shift in the housing market can lead to an economic nightmare. Home builders would begin to cut back. Demand for commodities and materials would start to sink, and ultimately, the need for durable goods like washers and windows plummet. And all this results in massive layoffs and an explosion in unemployment. That economic disaster doesn't stop there, as it will quickly spread throughout the rest of the economy and decrease the buying power of hundreds of millions of Americans, and force families to reduce spending. All this in the hopes of curbing runaway inflation. So, it has everything to do with you. These next 8 to 14 months for the housing market will be very telling whether or not we fall back into another recession, perhaps one even more significant than the last Great Recession of 2007. The Federal Reserve takes action. For the first time since 2018, the Federal Reserve and the central bank raised rates. According to Freddie Mac, an industry in diversified financials, the average 30-year fixed mortgage rate spiked from 3.11% to 5.54% in the last 6 months and is not showing any signs of slowing down. Many in the real estate business knew that higher mortgage rates were inevitable, but they never dreamed that they would explode to these heights. Sure, this may be an excellent way for the Fed to fight inflation, but it also means they could end up declaring a recession. The possibility of a Fed-induced recession is real, especially with the slow housing demand we're seeing today. Alongside a potential Fed-induced recession is the drop in U.S. house prices. According to John Burns, Real Estate Consulting, the housing cycle has already turned over. However, Redfin's chief economist, Daryl Fairweather, calls the market contraction a housing correction, and not so much a crash, even though mortgage applications are down 19%. According to Fairweather, it's not time to sound the alarms yet. The Fed takes on lessons it learned from the last time this happened back in the 1970s. Only this time, the government faces more tremendous obstacles like the COVID-19 pandemic and supply chain issues. Supply chain crunch. The supply chain restraints and labor shortage discouraged a speedy ramp-up in home building when there was a rise in demand for new homes. There was a pandemic housing boom during which, in the U.S., house prices spiked by 42%. The pandemic-induced frenzy was something never before seen, as fundamental guidelines in the ordinary housing market were thrown out the window. Home builders could not keep up with a burst in demand for housing. Something similar happened in the 2000s housing bubble that ultimately led to falling home prices for multiple years and hit so hard that the real estate industry has yet to recover fully. Another distant time during the 70s boom was much more similar, as it occurred during an inflation boom, one like we're seeing today. The supply and demand mismatch back then sent U.S. home prices up 167%. Of course, the Fed followed suit by spiking mortgage rates that peaked at 18% in 1981. Experts such as Patrick Bet-David are confident that mortgage rates may see a similar spike within the following year. He says, don't be surprised to see rates go up easily to 10%, maybe even 15%. The situation back in the 80s was wrangled before a severe housing crash could occur and return to a balanced market years later. But just because we've cleared a housing crisis before doesn't change the fact that we're still in a sticky situation. Is this the next Great Recession? It is vital to observe history and note trends that correlate with the rise and fall of the economy. One famous economist on the National Bureau of Economic Research, Edward Leamer, did that in a published paper called Housing is the Business Cycle. In the paper, he argued that residential investment offers the best early warning sign of an oncoming recession out of all the components for GDP. At the time of its publication in 2007, Leamer provided evidence that since World War II, 8 out of 10 recessions were preceded by substantial problems in housing and consumer durables. According to the paper, things aren't looking too good moving forward, and many more economists agree. The evidence drives Mark Zandi, Moody's Analytics chief economist, to predict a 55% chance of a recession over the next 12 months. Zandy predicts that housing markets with overhauled homes could fall 15 to 20% if a recession were to hit. This is only a prediction, but many signs indicate a recession. How significant or severe the looming recession will be is something yet to be known. So when will this housing bubble end? There's a technology executive named Bill McBride who gained fame for predicting the housing crash of 2007. His economics blog, Calculated Risk, has been spot on when predicting major economic events as far back as the early 2000s, so it's no surprise that people are looking to listen to what Bill McBride says about the current predicament he calls a perfect storm. According to McBride, he's never seen anything like it. To give an example of how crazy things have gotten in the housing market, Glenn Kelman, CEO of the real estate platform Redfin, stated that home buyers are bidding on homes blind. They're not even bothering to visit the homes before buying. There were also causes of couples leaving multi-million-dollar homes in Los Angeles, migrating to Texas, and dropping $1 million on a $500,000 house. Kelman also reported an even stranger offer where a buyer in Maryland offered to name her firstborn after the seller. Total insanity. As wild as this madness has been, that didn't stop McBride from seeing the housing market mayhem coming long ago. One of the most predictable factors detected early on was how the slowed construction and home building that lingered from the Great Recession of 2007 would intersect with the coming of age and demand for housing by the millennial generation. The depleting of the housing supply couldn't have come at a worse time, as America's largest generation would inherit a skewed housing market. It wasn't just the aftermath of the previous recession. The pandemic didn't do much to help either. There was a considerable pause in construction and colossal disruption in supply chains that made development near impossible. Not only that, but skyrocketing lumber and material prices further exacerbated the crisis. So, in these uncertain times, of course, the world would look to the economic Nostradamus and look for answers for what will happen next. It just so happens that Bill McBride isn't some soothsayer or psychic. The formula he uses is much more scientific than anything else. McBride states that it's much easier to gauge the available housing inventory than to measure the demand. If you're looking to discover what happens next, you'll need to pay attention to the inventory statistics. In April, active inventory had crashed to an all-time low. However, we've seen an increase in that same inventory for 3 weeks straight. That may sound like something worth celebrating, but hold the champagne. According to McBride, at the slow pace we're seeing, the inventory of houses on the market won't return to normal for about 14 months. According to a real estate research firm, Altos Research, more homeowners are reducing their prices to sell. More current trends tell that the inventory is increasing as well. McBride seems to have a reasonable approach when asked if buyers should be willing to keep raising their offers and buy now to avoid further high pricing spikes. In an interview with The Atlantic, McBride said, "It's so hard to say without knowing the city, but generally, if you're in a market where you consistently have to spend significantly above listing, I wouldn't buy right now." He then followed with, "I think when you put everything together, the odds are that things get more normal in a year." Well, until things return to normal, what we know is that the new data from the Commerce Department reveals that U.S. GDP shrank in the first 2 quarters of 2022. Some experts say that's the technical definition of a recession. The White House has denied this and is refusing to accept the telling signs. So what do you think? Will this be the next Great Recession? Will the housing bubble finally burst? Only time will tell.